Good afternoon and welcome to today's Equity Release webinar. I'm Vicky McDade and I'm an Equity Release trainer for Responsible Equity Release. Responsible Equity Release are specialists in the UK, and as we only advise on equity release, this allows us to be experts in our field. Over the next 30 to 40 minutes we'll be updating you on the current equity release market and reminding you who in your client bank may have a need for this product. Financial planning for retirement has seen many significant changes recently, making it more important than ever that those approaching and in retirement consider all of their financial options. Equity release and retirement mortgages have an important role to play. However, they are often misunderstood or overlooked. Our aim is to clearly explain the products now on offer, because there have been recent innovations, who these may be of use to, and how your clients can access the best advice even if you aren't qualified to advise on these products. In fact, by leveraging our expert knowledge and preferential rates, your clients will receive the best advice and could save money in the long run. At the end, we will open up the floor to your questions, which you can submit via the question function at any point on your screen. Today we will cover the equity release market size and potential growth areas, and the product basics and who is eligible. To identify how this relates to your client bank, we will look at what equity release is used for and give you insight from new research covering customer profiles. We will then cover the equity release providers and which products they offer. Having whet your appetite, we will then look at how you can get active in this marketplace, and the referral process will show you how equity release can be an extra income stream for you, even if you don't hold the relevant qualifications. Our unique approach is summarised here with a quote from our Managing Director, Steve Wilkie. We have designed the business model around the weaknesses in the market, kept our focus and continued to fix these weaknesses that we identified. The first issue we aim to overcome is one that concerns the regulator and the Equity Release Council, the issue of dabbling advisors, those that only occasionally write cases. It is difficult to keep up to date with the equity release marketplace if you only write 1 or 2 cases a year. As dedicated specialists in this market, we keep up to date with new products and regulatory changes. We have excellent relationship management tools in place to assist us in keeping the customer informed. Our advisors have over 150 years of collective experience and keep the customer at the heart of everything that we do. Responsible Equity Release also pride ourselves on working to spread the word about equity release, and we have developed relationships with strong household brands so that our target market regularly see articles and receive information about equity release. Let's start with a recap of the basics. Equity release is a product which allows older homeowners to raise funds via a mortgage that does not require monthly payments to be made. The interest rate is fixed at outset for the life of the loan. There are now hybrid mortgages available, which I'll give more detail on shortly. Typically, instead of payments being made to the mortgage provider, the interest rolls up and is repaid with the original capital released at the end of the customer's lifetime, or when the property is sold if they move into residential care. The customer retains 100% ownership of the property, so they do not need to worry about being evicted. The products and advice are regulated by the Financial Conduct Authority, which should provide customers peace of mind. And additionally, the Equity Release Council ensures that products adhere to a code of conduct which provide extra guarantees, such as a no negative equity guarantee, which means that the loan will never be higher than the value of the property, so no debt would ever be placed on the estate. This means that more clients are happy to consider equity release because they know they cannot lose their home or be a financial worry to their beneficiaries. Let's have a look at some of the significant figures that will help to explain why equity release has been a growing market recently and will continue to grow in the coming years. There are 7.6 million eligible candidates offering only around 20,000 plans are written each year. so the current market is only a fraction of the potential market. Many retirees are asset rich but cash poor, and 45% of retirees have inadequate income, yet pensioners have £807 billion worth of housing wealth. Investing in their properties seems to have paid dividends though, as the average property price has doubled since 2000. The post-war baby boomer generation have begun retiring, and this proportion of the population is set to increase to 19 million by the year 2050. The equity release market has been growing over the last few years, and there is now more than £1.4 billion being released annually. But with so many more people eligible, this has the potential to be so much higher. Another factor which has the potential to greatly increase equity release lending is the interest-only mortgage time bomb. Research shows that £116 billion of interest-only mortgages are due to mature over the next 8 years, many with no repayment vehicle or strategy in place. For some, switching to a capital repayment mortgage may be an option. However, due to recent income criteria changes as a result of the mortgage market review, they may only have a few years left to repay a large amount of capital, which means that the increase in payments may be unmanageable. Some may consider downsizing. However, having been in their homes for many years, they may not want to do this. Equity release could be an option for those affected. The equity release providers have responded by creating new products, not all of which fit the typical equity release profile, but may allow these customers to access a solution which allows them to stay in their homes. So, who is eligible for equity release? Quite simply, the youngest person on the deeds must be aged 55 or over. They must be a UK resident, and the property must be worth at least £70,000, and they may be wanting to release a minimum of £10,000. There have been many innovations in the marketplace over the last few years, which we will cover in more detail soon, but there are providers that will now consider second homes subject to certain criteria, although that may be a small part of the market. Looking at what equity release is typically used for may help to explain in a bit more detail. Equity release can be used for any legal purpose. There is no such thing as a typical client. Many financial advisors consider that equity release is a last resort product or only used by those who have not planned adequately for their retirement. This simply is not the case. Recent research shows that a significant percentage of the funds released are being used by the financially astute. Equity release is increasingly being used as part of financial planning in retirement rather than as a fallback option. Home improvements remains the largest factor for releasing funds. There has been an increase in lending though to repay outstanding mortgages or help family members. It can also be used for home purchases, upsizing or second homes. This point is very important as it's often overlooked. Equity release plans can be used for purchase. So for example, let's say you have a couple who live in a £180,000 house but want to move to a £200,000 bungalow but can't raise the extra £20,000. By taking equity release on the bungalow, this allows them to raise the £20,000 needed to complete the purchase and live in the house that they choose, rather than the one they have to settle for. Many people may worry that by using equity release, they are reducing the amount of potential inheritance that may be left. But by using these funds to help family members with education or getting onto the housing ladder, they could be providing more financial help by helping them to secure better paid jobs or building up property in their own equity in their own properties. They could be supplementing their own income or investing in property to provide a rental income. As specialists in the equity release market, we know the provider's criteria very well and are able to help more people achieve their financial goals. We have received new insight from the 3 largest providers of equity release, covering applications written over the last 4 years. There are 59 different customer profiles in total, and the top 3 profiles account for 14% of all applications. These reveal that equity release is being used by the financially astute. It's not just a low-end product for those that haven't planned properly. To help you identify these potential customers within your own client banks, it's worth taking a look at them in more detail. 5.2% of applications come from the segment described as sophisticated stability. 58% of this group are in the age band 58 to 67, and their average property value is £363,449. They are some of the most affluent people in the UK, professionals and business owners in their late 50s to early 70s. Many are seasoned investors, not adverse to taking risk or exploring new investment opportunities. They want growth and income, and most importantly, to minimise tax. Financially astute, they are comfortable using loans and are a very low credit risk. They work at the most senior levels as managers and directors and are twice as likely as the national average to be self-employed business owners. Typical occupations include accountancy and business management. This group may not be who you'd expected to be using equity release plans, but they are the segment that account for the highest percentage of applications. The next segment in terms of percentage of applications are those termed middle age spread. While the typical age in this segment is lower, 19% are in the age band 56 to 67, therefore fitting the equity release age criteria, which might actually lead us to believe that these are the most likely candidates to be using equity release, as a higher percentage of applications come from a smaller group. Their average incomes are above the UK national average, as are their property values. They are active, moderate investors. Pension-related investments are of high importance. ISAs and protection also rank highly in their portfolios. They tend to work as managers and in clerical work in both the public and private sectors, and an above-average number are self-employed. They are the most likely group to still be carrying a mortgage onto their property. Can you recognise these people within your own client banks? The careful experience segment belongs in the retired wealth category. These are affluent, largely retired professionals in their late 60s and 70s who have prepared for their retirement through wise investment. Many own their home outright and with no mortgage to pay are able to invest their money in a wide range of financial products. They invest in unit trusts, ISAs, onshore and offshore bonds, and a significant number have already purchased an annuity. They are concerned with maximising their pension pots and maintaining their standard of living as they come to the end of their working lives. A substantial number of people in this segment are retired, though some still work at the managerial or director level. A substantial number of people in this segment live in high-value detached properties. As you can see, this financially sophisticated group account for a significant percentage of equity release applications, although they might not be the type of client you would have expected. The reason we have outlined these client types for you is to show you that you may be missing an opportunity if you prejudge who may be interested in equity release. With the products being used for such a wide range of reasons, it makes sense to make all of your clients aware of the products available, particularly if they fit the profiles that we've outlined. But if they don't qualify yet, then they may well have other family members that do. Equity release providers are typically life companies, insurers or specialist lenders. There has been talk of some of the high street lenders entering the market over the coming months, and this again should boost the market. The more people that offer equity release and advertise its existence can only help to increase consumer awareness. As a specialist advice company, we have been able to negotiate specialist rates and deals on behalf of your customers. We have also been able to provide input when these companies are designing new products to help ensure that they create the products that have the features that will provide solutions to the problems that this generation of retirees are facing. A large proportion of today's retirees have health concerns, and many providers will now take these into account and may be willing to lend a higher proportion of the property value to those affected. Equity release plans covered by the Equity Release Council's guarantee have three basic formats: a lump sum roll-up mortgage, where the funds are taken as an initial release; drawdown plans, where a proportion of the funds are taken at the start and further funds are available on reserve if needed in the future. And we'll look at the new interest service option in a moment. For the lump sum roll-up mortgage, recent council figures have shown that around a third of plans written are a lump sum plan, where all of the funds are taken at outset without a further facility. The average amount withdrawn is just under £75,000 and is roughly a third of their property value. This sector of the market is on the increase, and the average age of these customers is 68.8. Drawdown plans account for 2/3 of the market. This is where an initial sum is released but further funds are available in a reserve facility. Interest is only charged on the funds released. The average release is therefore lower at just under £58,000, but they will be able to increase their borrowing in future years. These clients are typically a little bit older at 71.6 years, and the value typically released represents around 20% of the value of their homes. Some of these plans allow the client's state of health to be taken into consideration. If they have health or lifestyle factors that affect their longevity, they may be able to release a higher initial amount. There are also plans which allow a portion of the property to be ring-fenced so as to provide an inheritance guarantee. Recent innovations have seen the launch of products where the interest can be repaid on a monthly basis. The amount of interest being serviced is a customer choice, and this allows the customer to protect more of their property for a future inheritance. It may even be that the beneficiaries want to contribute to this monthly payment to preserve their future wealth. The customer's income will need to be assessed and will need to fit the lender's criteria. But usually it will need to be retirement income payable for life. The income assessment is the responsibility of the lender. There is also an option to convert the loan to a roll-up plan if customers decide to stop servicing the interest, and this may happen automatically if a number of payments are missed. Plans are also available where overpayments of the capital can be made, and if this option is available, it is typically capped at 10% of the capital balance each year. These loans still fit the criteria laid down by the Equity Release Council guidelines. More recently, we have seen the introduction of retirement mortgages, which do not necessarily comply with all of the Equity Release Council guidelines. Essentially, the right to remain in your home for the rest of your life and to offer a fixed interest rate for life. Customers are required to pay the interest monthly, and if payments are not made, then their home could be at risk of repossession. There is an option to change the plan to a roll-up plan once the youngest borrower reaches age 80 and the payments have been in place for 5 years. The interest rate is also not fixed for life. The initial term of 5 years is fixed, and after which the customers have the option to fix for a further 5 years at the prevailing rate, or to remain on a standard variable rate. This gives the customers flexibility to benefit from future interest rate changes. The amount that can be borrowed is based on what will be affordable considering the customer's qualifying income. This type of plan offers a higher amount for younger customers, up to 50% for those up to age 70, 45% for those aged 71 to 75, and up to 40% of the property value if they are aged over 76. These new types of mortgage are proving popular as they bridge the gap between traditional mortgages and equity release lifetime mortgages. They are useful to those that have the income to make payments and who want flexibility to make overpayments and possibly benefit from future interest rate changes. Importantly, they do offer some of the features directed by the Equity Release Council, particularly the no negative equity guarantee. So the customer would never owe more than the value of their home, providing them and their beneficiaries with peace of mind. slide shows which providers offer which type of plan. Historically, the largest providers of equity release have been Aviva, Just Retirement and Liverpool Victoria, although we are starting to see changes in the marketplace. New providers have been quick to offer interest-only plans, while others are still developing new products. Not all providers take medical and health information into account, and as the market shifts, more providers are making their products more flexible to fit in with the needs of today's retirees. There has also been talk of new providers entering the equity release arena, potentially some of the high street banks. So we are sure that there will be more innovation and competition in the near future, which ultimately benefits the customers. Our advice process is designed to ensure all customers receive high quality advice from very experienced advisors. We only write equity release plans and as such are considered experts in our field. Typically, our advice is given face-to-face with 2 home visits to ensure that the clients have the opportunity to understand the products thoroughly and ask any questions. We also encourage other family members to attend, and we are happy for you, the introducing advisor, to also attend, which may help to increase your knowledge of the products and the specific advice process. We also ensure that any recommendations are reviewed and signed off by 2 advisors. Our advice is given without obligation, and we only charge an advice fee when a customer proceeds to take out a plan. This should give you peace of mind to refer any clients who express an interest, as they can investigate the options and are not charged if we cannot resolve their issues with an equity release plan or retirement mortgage. Now that I have shown you how you and your clients can benefit from a referral to us for advice, you might be thinking, who can I refer? If you start by reviewing your existing clients, those clients that undertake regular reviews with you, do you tell them about equity release? Those approaching retirement should be made aware that such products are available. Even if they do not need them now, it would make sense for them to know that if their circumstances change in the future, this option will be available to them. It may also be useful to know that these products can help them to help family members if their circumstances change. For those clients that do not undertake regular reviews with you, you could consider sending a newsletter to your client bank highlighting who can use equity release and what it can be used for. You might want to organise a client seminar providing information on equity release and other retirement products. You might want to email clients to let them know how to supplement their income in retirement. Referrals are a very effective way of generating leads. Do you ask for referrals at every client meeting? Do they have friends or family that can also benefit from expert, no obligation advice to explore their options? Once you have seen the benefits equity release can bring to your clients and how it can be an extra income stream to your business, you might want to generate leads from new clients. Responsible equity release will help you to do this by providing newsletters, advertising copy, flyers and even presentations for you to use at seminars or online. By attracting new clients who could have a need for equity release, whilst this could generate a lead to us, you will also benefit by helping them with their other financial planning needs. You might consider setting up a networking group or seeking out other professionals to work with, for example solicitors, estate agents or providers of long-term care services. Many referrals come from younger family members, so it might be worth considering advertising online. This could take the form of a website, blogging, podcasting or even broadcasting your own webinars. All of these can be effective for contacting new clients, and if you would like us to help you with a campaign, then please get in touch. By referring your clients to us, you are ensuring that they receive expert advice which can save you time whilst still allowing you to earn for any cases written. If you are not qualified to write equity release business, then this can be an extra income stream without the need for you to take more exams. The majority of advisors who are qualified still only write a few cases a year, And this means you need to keep up to date with product innovations, new lenders coming to market, changing criteria, all for just a few cases per year. As specialists, we focus solely on this market, and it's easier for us to keep up to date with changes because we only write equity release business. We're not distracted by other products. This also allows us to negotiate specialist terms with the lenders, and this means that your clients will benefit from lower interest rates and will receive a share of a higher commission amount. And we also have access to dedicated case handlers with lenders and solicitors to ensure that any cases complete smoothly. I'd like to demonstrate our rates with a few examples. As specialists, we can negotiate better interest rates for your customers, which can mean a significant saving over time. Just as important is our knowledge of lenders' criteria and helping customers to shape their cases to ensure their needs are met in the most cost-effective way. Let's consider a couple aged 60 with a property value of £220,000, and the fact find reveals that the clients would like £40,000. If you sourced this amount from Aviva, the rate applied would be 5.77%. With our specialist knowledge and access to flexibility from Aviva, a responsible equity release advisor would suggest that if they reduce the amount being borrowed by just £400 to £39,600, then the interest rate applied would be significantly lower at 5.4%. Over 20 years, this represents a saving of £8,314. Great news for the customers and for their beneficiaries. Our second example also shows how shaping the case can affect the interest rate and still ensure that your clients achieve their financial goals. Let's take a 70-year-old couple with a property value of £500,000. They would like to release the sum of £100,000 now and would like to have a reserve of £60,000. If you sourced this amount as requested of £100,000 and £60,000 reserve, then the interest rate on the initial amount would be 5.33%. Responsible equity release advisors, by using our fact find and probing further into the client's anticipated future needs, would decide to set the reserve at a lower figure of £40,000, which would still be sufficient for the client's needs, but would reduce the initial interest rate to 5.21%. Over 15 years, this represents a significant saving of £3,964. The benefits of introducing your clients to responsible equity release, as well as the expert advice, is that they can benefit from preferential rates from the lenders. But you will also receive a share of the higher amount of commission that we have negotiated with the lenders. In this example, consider a customer wanting to release £50,000. If you introduce your customers to an advisor who only writes a few cases a year, they will have to accept the lender's standard commission terms. In this example, half of £750, so £375 to you for your introduction. If you introduce to an advisor who is a member of an equity release mortgage club, they may have access to better terms, and you could receive half of a higher commission amount, giving you £500 for your introduction. However, by introducing your clients to us, your clients will benefit from significantly lower rates, and you will receive a higher share of our enhanced commission terms. We pay 70% split for the first 3 referrals and 55% thereafter. So in this example, that would provide you with £105 for your introduction, which was more than was actually paid to the first 2 advisors for writing the cases. So I hope that I have shown you why the equity release market has been growing and why it will continue to grow over the next year and decade. You can generate an extra income stream to your business and provide the best service to your clients by introducing them to responsible equity advice. This slide summarises the points that I've covered. We guarantee not to cross-sell to your clients, so you retain the relationship. You receive a generous split of our enhanced commission terms, and by referring the clients to us, you don't need extra exams, professional indemnity, and the time that you save by referring these customers can be spent on other areas in your business. We offer expert, independent, unbiased advice, allowing your customer to access all of the products available if appropriate. We have negotiated specialist terms with the lenders and specialist solicitors, which will save your clients money now and over the life of any loan taken. Your clients can choose face-to-face or telephone advice, and you and their family are welcome to attend. Your clients will benefit from expert, experienced advisors, and we have sophisticated support systems and teams to ensure that we provide the best possible service to you and your clients. Referring your customers to responsible equity advice couldn't be easier. Our website, www.equityreleasereferrals.org.uk, allows you to enter simple client details, age, property value, whether or not there's an outstanding mortgage, and their contact details so that we can get in touch with them promptly to arrange a meeting to discuss their needs. You can also call us free on 0333 144 115. We're happy to answer your questions to see if Equity Release can help your clients with their financial planning. When you register on this website, you will also be given access to marketing tools that will help you generate referrals from either your existing clients or from new clients. I would like to thank you for joining us today, and I hope that I have shown you how referring clients to Responsible Equity Release can help your business and your clients. Next time we'll look in a little more detail about specific products, particularly the retirement mortgage, and provide some case studies. With new products coming to market, those struggling to pay off a mortgage before their retirement may be able to access a solution that fits their budget. And of course, more people would want to help family members and provide an early inheritance. We'd now like to open up the floor to your questions. So if you have any questions, if you open up the question box in your dashboard and type those through, those will come through to me. Okay, the first question that's coming through is with regard to health and lifestyle factors. We've had a look at those. I mentioned that some providers will actually offer you a higher amount or offer your clients a higher amount if they have health and lifestyle factors affecting their longevity. It might be as simple as either sort of being a smoker or being overweight, having diabetes or heart conditions. So really the idea is to take all of that medical information into account, and some providers will actually provide you with a higher amount of being borrowed, so if they're looking for a maximum, that can be useful. Or there's one provider in particular who might actually use that information to reduce the interest rate on the amount being borrowed. So it's always worth taking that into account. I've been asked to repeat the web address, so I'll just bring that back up onto screen there. So as you've got there, it's www.equityreleasereferrals.org.uk. And as I say, when you register on that website, which is literally just putting in your name and contact details, that will actually give you access to the marketing materials immediately. You'll be able to go in and download a presentation as well as some copy for websites or for articles. The question there, what are the maximum loan to values available? The majority of them are all still linked to ages, so it very much will depend on the youngest applicant if it's a joint application. Typically the maximum is probably about sort of 50%. Somebody that is that has a lot of health issues may be able to just get above that. But again, that would tend to be at the older ages. So it might be that if your clients were nearer to the 60 age group, they might have a maximum amount of 20%, which is where it's quite interesting with the retirement mortgage, specifically that provided by Hodge, where they actually turn the tables on the age criteria, and actually they'll offer a higher amount to younger customers. So for the youngest customers there, they might be able to get 40%. So again, that's going to depend on whether they're looking to service some of the interest or whether they're hoping to have a product that rolls it up. But yeah, typically the maximum would be about 50% of the loan to value. It could be 20%, sort of depending on their age, and all of those other criteria is taken into account. With the traditional equity release, the roll-up and the drawdown, the credit rating doesn't really come into it because the security for the loan is the property, so they're not being asked to make monthly repayments towards the interest or capital, so they don't have to have a certain level of income. There doesn't need to be any particular security there, although they will ask questions about creditworthiness, whereas with the interest-only options and the retirement mortgage, then if they're looking to service the interest, that will have to be provided to the lender. It's the responsibility of the lender to assess that income and to assess whatever is affordable. So the clients may suggest that they want to service 100% of the income, their interest, and let's just say that's £300 a month, but after having been through the provider's affordability checks, it comes back and says that there's only £200 a month available. Then £200 of the interest will be serviced monthly by the client, and the other £100 a month will be on a roll-up basis. So for some of the interest-only service products, there's a kind of balancing act of some of the interest is being serviced on a monthly basis and some of it's being rolled up. Another question there, is there a lot of compliance involved, proof of income, etc., or is it all based off of the valuation of the property? For the traditional roll-up and drawdown mortgages where they're not looking to service any of the interest, then no, that would all be based off of the property of the valuation, definitely. If they are looking to service the interest, or if they are going for the retirement mortgage, then yes, there would need to be proof of income available. That might be sort of P60s, pension statements. Again, for some of the younger customers looking to take the retirement mortgage, which is available from age 50, you might be looking at things like pension forecasts, because they obviously haven't started to draw those benefits yet. So again, that all comes down to the lender's criteria, but again, that's where referring through to us as experts is very helpful. Okay, another question there. Can we go over the flexible lifetime plan bullet points again? The flexible lifetime plans, I think what we're looking at with those ones is that a number of providers now, typically Hodge and Aviva, and I think one or two of the other ones, perhaps Stonehaven, are allowing 10% capital overpayments. So whether or not they're looking to service the interest, some of the plans will actually allow you to overpay allow you to overpay the capital as well. Typically that's capped at 10% of the capital that's been released, and so as well as, or in addition to making payments towards the interest, they can actually start reducing the capital balance. So that's typically capped at 10%. You have the situation with the Hodge retirement mortgage that they also have a fixed early repayment charge scale. So clients and customers are allowed to pay up to 10% of the capital a year without being subject to any early repayment charges. If they repaid over that amount in the first year, they'd be subject to a 5% early repayment charge, and that's 5% of the amount being overpaid. In the second year, it goes down to 4%, third year 3%, fourth year 2% and fifth year 1%. So after 5 years, actually they're able to overpay as much as they want, not subject to early repayment charges. So they'd be able to completely repay it within 5 years, and that could either mean that, you know, perhaps if they're taking it at a younger age, perhaps they're one of those people caught up in the interest-only time bomb. In 5 years' time, maybe using tax-free cash or an expected inheritance from older parents, they can actually repay the mortgage and take that away. Or it might be that they're looking to review that mortgage after 5 years and maybe go with a different provider. I mean, certainly looking at the market today and the products and the rates that are available, if we look back at how that was 5 years ago, it's very different. So having that flexibility in charges or the flexibility to make overpayments, and particularly with the Hodge product that they're only tied into that interest rate for 5 years, means that actually in 5 years' time they'll be able to look at that again. That's one of the only parts that is slightly different to the Equity Release Council, because the products that conform to their code of conduct means that the interest rate is fixed for life. So if interest rates were to drop, if they fix now at 5%, 6%, if interest rates were lower in 5 years' time, they're not going to benefit from that. But you can always argue both sides of that, that perhaps interest rates are incredibly low at the moment, so actually in 10 years' time, if interest rates have risen, then being locked in for the life of the loan could be beneficial to them. So there's always two sides of looking at that particular issue. With regard to early repayment charges, it's another question coming there covering those. As I've mentioned, for the retirement mortgage and some of the other lenders, they have a very simple structure that it's a set percentage. I think LV also have it as a 5, 4, 3, 2, 1 over 5 years. Some of the other providers, for example Aviva and Just Retirement, tend to have any early repayment charges linked to gilt. In the case of Aviva, specific gilt, or with Just Retirement, the 15-year gilt yield. So whilst they're tied in for life, there are obviously certain criteria where an early repayment charge wouldn't be counted. So for example, if they were moving into long-term care and repaying that, some of them have a caveat that if the individual gilt or the gilt yield has moved by 0.2 or 0.25, then there wouldn't be an early repayment charge. So really depending on what, you know, being retired, if you're sort of retiring sort of 60, 65, with longevity, people are expecting to live maybe 20, 30, 40 years now. More and more clients are interested, particularly the younger age group, are more interested in the flexible elements. So of course, as experts, we can sort of speak to them. Our fact find process is very comprehensive, so that we look at, you know, have they still got older parents around? Are they expecting to inherit any money? Are they looking at any pension windfalls, tax-free cash to be available? And trying to pick the right product for them that will allow those anticipated changes, as well as obviously having an element there of being able to change with changes that we would expect to happen. For example, deterioration of health, that's bound to occur at some point, typically maybe from age 75 overwork or over. So again, that's really our knowledge of all of the different types of products and how the particular options within those products will affect customers now and in the long term. Another question's coming there: is there excessive paperwork and compliance involved for the client to sign? From the client's point of view, no. There would be an application form to sign. There also needs to be, as part of the Equity Release Council's guarantee, they need to be receiving independent legal advice. So there would be a solicitor's certificate that needs to be signed. It's not something for the client to sign, but it does mean that the client has to have had that meeting with an independent legal advisor, and part of that meeting is to ensure that they fully understand the product that they're taking, and the consequences of any action. So how, I mean, the advisor will explain to them how the loan will roll up over time, but again, that's something else that the legal representative will make sure that they understand. So yeah, other than excuse me, other than the paperwork for the application, that's something just for the advisor to complete. So again, you know, we've got our fact finds and application forms. There's not very much actually for the client to do. There might be a little bit more involved if they're looking at one of those products where they're hoping to service the income, because obviously they'll need to find copies of their income to provide proof of that. Another question has come in there: do referrers have to be regulated IFAs, or can we take referrals from anyone? As far as I know, we can take referrals from anyone, as far as I know. Whether or not that's I know from some of the other specialist providers there's a difference in how much that they're able to be paid. I think one other company that I'm aware of were paying non-regulated IFA something like £5 for a referral, whereas obviously we would prefer to deal with regulated IFAs because it kind of sort of works slightly better in us that you will have pre-qualified that client from the information that you've gathered here today. While you may not have the exam or that expert knowledge on which product's going to be right for that person, you've already spoken to them and you're aware of their general overall financial position in order to refer those through. But again, it might be a case, as we mentioned, that if we were to gain sort of referrals from mortgage introducers, they might be qualified just to write mortgages and not have investment advice as part of their qualifications. If you're looking at solicitors, again, they're qualified in a different way, providers of long-term care services. So what we would say, perhaps to you, and as we sort of mentioned, that if you've got those kinds of people in mind, it might be an idea that they're referring those cases through to you, because again, if somebody's considering equity release, the best thing for those customers and for the industry as a whole is that their whole financial situation is looked at. So it might be that they're looking to take the funds, but what are they going to do with those funds when they've taken them? Is there an immediate need, which means all the money is going to be spent, or are they, you know, thinking of having that as a rainy day fund? So certainly, as a specialist company, responsible equity release advisors are all qualified to give that advice. Again, you know, we can have referrals from anywhere really that comes through. So I think part of the equity release site, certainly again, you can have referrals either directly through from the customers or from those regulated. In terms of the interest rates being offered at the moment, there's another question there. There has been a lot of change in the marketplace recently. It's difficult with one provider, Aviva, because they offer this flexible interest rate. It's difficult to know what their range is. But again, those that do advertise a rate, there has been significant reductions across the marketplace just in the last couple of months. Whether that's because certain providers are coming up to a end of year amount and they're looking to take funds in. What we do need to be very careful of is that if people are comparing equity release interest rates to those of mortgages of 2 or 3%, that you're really comparing the same sorts of things. As we mentioned, with the exception of the retirement mortgage, that interest rate taken today will be fixed for the life of that loan until that's repaid. That could be 10 years, could be 25, could be 30 years or even longer. So that's why they don't really always compare with the interest rates being offered in the mortgage market. So that might be a question that comes up, particularly for those younger customers that are just coming away from normal residential mortgages, perhaps those interest-only ones, wondering why there's a difference of rates there. Rates with equity release tend to be slightly higher as well because they do have that no negative equity guarantee and that right to remain in the property at all times, whereas you don't get that with the residential mortgages. Having said that, the retirement product that fits neatly into the middle of conventional mortgages and traditional equity release, their rates at the moment are just over sort of 4%, 4.2, 4.3. So they kind of sort of fit neatly in the middle. They have some of the guarantees from the equity release, which makes them slightly more expensive, but they also don't have some of the elements there, which means that they can be more similar to the normal conventional mortgages. Another question comes through about types of properties. So the properties do need to be in the UK. If people are looking for properties abroad or for second properties, I think there's one or two lenders that may actually allow them to raise a mortgage on the second property, but the majority of the market, as long as the funds are being raised on the main UK residential property, again, whether they're using that to buy other property abroad or to buy a second property, whether they're using that for buy-to-let as a deposit for that, provided the equity release is taken on the main property, that's not too much of a problem. Providers' criteria do vary quite a lot. I mean, we have a very large sort of software matrix that we can use, which will cover things like whether or not they've got flat roofs, whether there's a certain amount of land that can be attached to the property, whether or not they take thatched roofs, commercial properties. So it can be used on a wide variety of properties. I'd say the best thing to do for that is obviously to give us a call in the office if you've got anybody that you're thinking of. If we mentioned, don't try and sort of prejudge and say, well, I'm not sure if they do that. Just pick up the phone, have a quick word with us, and we'll be able to let you know whether or not that is something that's going to be available to your customers, and therefore it's worth sending the referral through so that we can have a look at the option. And again, part of the service, as I've mentioned, is that any advice that we give is without obligation and without fee. We only charge those parts only come into it once a product is actually taken. So refer as many people as you can, get as many people into the process of having that advice, because either they've got a need for it now or they may well have that need in sort of 5-10 years time. Ideally, we'd like to see equity release being discussed with everybody as they approach retirement, either for that to be used as part of their overall wealth, or just certainly to make aware that should they decide to take all of their pension funds now, at least they have that property in the background. So equity release might be more of a when are we going to use the house asset to provide you with either extra income or provide them with long-term care that they might need later on, rather than if they're going to use the property. Cool, I think we haven't had any questions coming through for a few moments, so I'll give you just a few seconds more. If you've got any last questions that you want to send through, please do so. Otherwise, as I would say, the agenda slide that forms part of this, that can be used for CPD if you add in those learning objectives together with a reflective statement of what you've learnt and how that applies to your business. After the presentation, copies of the slides or copies of the presentation will be emailed out to each of you, so you can come back and refer that. But again, what we would really ideally like everybody to do, if you haven't already, is registered on the website, so that we've got your details. If you've got any cases, send them through, and of course details there of our Partnership Development Executive, Tom Brett. Give him a call, or any of the guys in the office. They'll be able to talk you through that referral. And obviously as well the assistance with marketing campaigns, so you might want to dip your toe in the water with one or two customers. Once you've had a positive experience from that, hopefully then we can look to help you with extra marketing campaigns, so that we can help more of your customers, provide that extra income stream into your business, and hopefully provide a sort of win-win situation for everybody. So I hope you enjoyed today's webinar. Thank you very much for staying with us throughout the questions. If you need anything else, obviously do get in touch with us, and hopefully we'll see you on the next webinar. So thank you very much, and goodbye from me.